Today we want to talk about, continue talking about international portfolio management. So this would be the topic number 8. This is slide number 20. So on slide number 20 you have the title for this slide called Home Bias in Portfolio Holding. And home bias means that investor tend to invest in domestic stock and bond and domestic asset, and tend less willing to invest outside of the home country. Okay, this kind of tendency we refer to the home bias. Next slide. So this is here we have a different degree of home bias. Let's pay attention to the bottom row for the United States. And here we can see that the US stock market representing almost a half, about 44% of the global capitalization. But we, American investor, invest on an average about 86% of our capital in domestic stock, and we only allocate about 15% of our wealth outside the United States for equity investing. So this 86% is much higher than the 44% of the market share, and this representing a quite substantial degree of a home bias. And home bias is not just occurring in the United States. Let's look at, for example, Brazil. Brazil, nearly 100% of the Brazil investors, they all just invest in Brazil. So we have 100% number for that nation. And obviously that it's probably much more difficult for Brazil investor to invest outside of their country, potentially due to limitation on their investing. And so different nations have different national limitation about to what extent their national citizen would be able to invest outside of their country. And another extreme example would be North Korea. North Korea will not allow any North Korea citizen to invest outside of North Korea. And there are nations that have been, historically speaking, invest a lot of their wealth outside of their home country. For example, let's take a look at the Germany. Okay, Germany only invests 29.35% within Germany and invests almost 70% outside of Germany, and that is because Germany is a member of the EU. And it's easy for them to invest in French stock, easy for them to invest in other EU capital market. So home bias sometimes also closely tied to the political environment as well. Next slide. And why we have this kind of home buyers tend to invest in domestic capital market? There are 3 conventional explanations. The first one is that investing domestically has a superior inflation hedge. What does it mean by inflation hedge? That means that the tendency whenever we have inflation in the domestic market, we tend to make better return from our investment. Therefore, the better return from our investment would be able to pay for the increase in those goods and prices for the service, etc. So that is a hedging. That means that we'll be able to better protect our purchasing power. And when you invest domestically, this kind of a property, we tend to have this kind of nicer property. Another reason is that home bias may reflect institutional and the legal restriction on foreign investment, as I mentioned earlier. Not every country allows their national to invest outside of their nation. And extra tax and transaction information cost, right? When you invest internationally, you deal with a very different operating environment, and the language could be quite different. So if you want to invest in, for example, Chinese stock, you'll be wise that you'll be able to read a little bit Chinese, and vice versa if you want to invest in a Japanese company. And a lot of the 10K, 10Q are published not in English but in Japanese. So there are language barrier. Next slide. So we have these two research have shown that wealthier, more experienced, sophisticated investors are more likely to invest in foreign security, and for an obvious reason that this kind of experienced, sophisticated kind of investor, they are much better equipped with a research capacity to deal with those kind of transaction barrier and information barrier that for international investing. And Chen et al. In year 2005 paper also find that when a country is remote and has a common language like Japanese, foreign investors tend to stay away. Okay, they will not invest to full extent just because of the difficulty of obtaining up-to-date and relevant information. And next slide. So how to structure international investing? International investing usually is structured as a so-called top-down approach. Top-down approach refers to that first we study at the macro level, like GDP growth, like foreign exchange, all those kind of macroeconomic environment. And then we're coming down to the individual stock, individual bond associated with those various different companies. So going from the top and then to the bottom. And this entire process, we can kind of separate them into four different stages. The next slide. The first stage is about doing research. Okay, we will need to have information. Information require research, and we will need to research at the macro level, also at the micro level. At the macro level, we will need to form forecasts about exchange rate, interest rate, inflation rate, GDP, and unemployment rate, and etc. So we want to know about the global macroeconomics. And then we will need to study individual firm at the micro level as well. We will want to know about their profitability, revenue, free cash flow. We want to do pro forma. We will need to figure out the cost of capital, etc. So those are kind of homework that we will need to go through as a research department. That would be the first stage. Once we have all of those necessary information, the second stage, that will be the next slide. The institutional investor will need to first make a decision at the macro level about the asset allocation. Asset allocation for international investing is usually done along the national line, in the sense that you need to ask yourself the question that what percentage of my capital are going to invest, for example, in the United States? What percentage of my capital is going to invest, say, in Japan? And so this is a kind of the question that one will need to ask in terms of the major category allocation. Okay, and this kind of category allocation could be defined along the national border, could also be defined across the industry. For example, what percentage of my capital I want to invest in semiconductor industry? What percentage of my capital are going to invest in auto industry? So national border is one way to make the asset allocation. Another possible dimension is the industrial classification. And sometimes we also have doing this kind of the allocation along with different kind of investment type. For example, hedge fund, private equity, bond, stock, etc. So those are all possible way to define those major investment category and also the allocation of our capital along those major category. And that in this kind of allocation, usually a computer algorithm, a computer system will be used, and we are going to use the Markowitz portfolio optimization technique in this particular process and come out with the so-called optimal portfolio allocation. Next slide. And for example, let's take a look at the asset allocation for Yale Endowment Fund. Yale Endowment Fund is institutional portfolio. We're talking about $30 to $40 billion. And as you can see that here they have 9 asset classes, starting with the leverage buyout, venture capital, all the way down to cash and equivalent. Okay. And as time goes by from 1985 all the way to 2015, as you can see that their allocation evolve as time goes by. And the beginning of this time horizon, that would be roughly about 1985. As you can see that the majority of the allocation go to domestic equity. That would be the stock in the United States. So in the 80s, this part of money, the majority of those money are in domestic stock. And as time goes by, as you can see that the allocation become more and more diverse, in the sense that and you have allocation into this 9 different groups. For example, right now the biggest allocation is leverage buyout. That's private equity. Private equity account for almost 20% of the Yale Endowment Fund. Okay, so this kind of allocation, I put about roughly 20% of this $30–40 billion into private equity, and this kind of allocation is what we refer to asset allocation. And once asset allocation, let's say that 20% of this $30 billion go to private equity. So we are talking about $6 billion. And $6 billion in private equity is a lot of money. And you are not just going to hire one private equity manager. Maybe you say that I'm going to hire 6 different private equity managers. Each one of them is going to be in charge of $1 billion, such that they add up to $6 billion, right? And then you will need to choose those managers. And then those managers, once they receive their $1 billion money, they are going to choose those companies to do the buyout. That's what private equity is about. And that will go down to the third stage, the so-called portfolio construction. When a private equity manager is chosen and being allocated with $1 billion, then this manager is going to form a portfolio of the buyout company. Maybe they're going to use this $1 billion to buy out, say, 8 different companies. And that is the portfolio construction. I mean, the choosing those individual companies to do investing. And so here we're talking about portfolio manager selection, and then the fourth stage, that would be the next slide. The fund sponsor, that would be the institutional investor like Yale Endowment, is going to do performance evaluation. They are going to track the performance of those managers that they hire and then evaluate their performance. And as time goes by, when a manager is doing well, then the institutional investor will say that, oh, this particular manager is doing a good job. Let's give this person, this company, a little bit more money to manage. And in contrast, if there is a manager haven't done a good job, then the manager might get fired, and then they are going to find a replacement for that. And that's what we to refer to the internal evaluation. And also they are going to monitor the daily operation of those managers they hire. So whenever a manager performs a trade on one particular day, at the end of the trading day, they surely will report those kind of activity back to the fund sponsor. And that would be part of the so-called internal monitoring. Make sure that they are doing all the right move, and whenever they have changed their position, and they will be informed. And performance evaluation usually will be done at a quarterly or on a yearly basis, and at least they will be done annually. Okay, so they often has an annual meeting, and all of those managers will need to be in that that meeting, and sometimes some people get fired. That's what happened. Next slide. In terms of the investment vehicle for international investing, there is one type of the security. It's called country fund. Country funds are traded on New York Stock Exchange, and it's a closed-end fund in the sense that if you buy a share of this particular country fund, and if you don't want to invest it anymore, you want a redemption, then you sell those shares on New York Stock Exchange to the next investor. So this is what we refer to country fund. And country fund, there are many, follow quite many country stock, like a Taiwan fund, French fund, Italian fund, etc. So if you wanted to have the exposure to one particular nation's stock market, buying or selling one particular country fund is one way to have that exposure. Next slide. Country fund is basically a group of foreign stock. So when you buy and sell country fund, it's very much like you buy and sell one nation's index. And sometimes you do not want to buy and sell the entire nation's stock. You just want to buy one particular company. And how you'll be able to do that in the United States? And the answer is ADR, American Depository Receipt. There are many big international foreign companies. They also list their stock in the United States. And the way they do this kind of listing is to go through the so-called ADR. ADR is that they deposit certain number of their own share in one particular American agency, like a Bank of America, for example. And then Bank of America is going to issue a certain number of ADR. For example, maybe every 5 Chinese share equal to 1 ADR, and those ADR will be traded in the United States, and so 1 ADR will represent a certain number of the foreign share of one particular company. And the good thing about doing and let's take a look at the example, the current example of those ADR, like BP, Barclays, that's a major investment bank in United Kingdom, Alibaba, that's a Chinese firm, and Taiwan Semiconductor, that's a Taiwanese firm, and LG Display, that's a Korean firm. So there are many of those foreign firms that have their share list on New York Stock Exchange or NASDAQ in the form of the ADRs. Next slide. And the good thing about investing in ADR is very convenient. It's convenience. And ADR are denominated in US dollars, so you'll be able to go on Yahoo Finance or Google Finance. You'll be able to find out the prices currently traded in US dollar, and the dividend will be denominated in US dollar as well. So you don't have to worry about foreign exchange rate, etc. So it's kind of convenient. By adding the ADR to an institutional portfolio is a very straightforward way to diversify away portfolio risk. Next slide. And so at individual stock level in the United States, we can invest in ADR. At the national index level, in addition to country fund, we also have the so-called WEBs. And those are the world equity benchmark shares, and they are issued by American Stock Exchange and managed by Barclays Global Investor, and they are basically ETF, so they are indexed, and their performance closely track those national indices. And currently there are more than 20 WEBs available on American Stock Exchange, including like Australia, Austria, Belgium, Brazil, Korea, you name it, all of those major nations. So if you say that based on my research that the Japanese economy in the next 2 years is going to perform relatively well, I believe that the Japanese stock market is going to outperform many national markets out there, then today you can just simply buy the Japanese web, okay? And that would be a Japanese ETF, and whose performance would be closely tracked to the Nikkei index in Japan. Okay, so that's one way that you'll be able to invest in international indices. Next slide. So webs and spider are SP500, that would be domestic ETF. Okay, there are basically a passive fund that mimic the performance of the indices. And good thing about ETF is that you buy and sell ETF very much like you buy IBM share. All you have to do is just submit the order through your online brokerage, and you pay US dollar for that. So it's very easy to trade with the ETF. Next slide. And here, the next slide, we want to talk about international money market. Money market are fixed income market, but with a very short maturity. That would be less than a year. So when we say that international money market, we just say that no, it's a short-term fixed income market. And euro currency, okay, is a time deposit in an international bank located in a country different from the country that issue the currency. For example, you create a time deposit, let's say a CD, certificate of deposit, with Barclays, that is a British bank in London, but this time deposit will be denominated in US dollar, such that you'll be able to earn the US interest rate. Then this will be the euro dollar. We call that is a euro dollar because it's a dollar denominated currency, but it's outside of the United States. In this case, that in United Kingdom. And another example is the euro yen. The euro yen are yen denominated time deposit in banks outside of Japan. For example, let's say that you save a pot of money in Japanese yen, say in Taiwan, earning the Japanese interest rate, then that would be the euro yen, because the bank is a Taiwanese bank, it's not a Japanese bank, while the time deposit is denominated in Japanese yen, and the interest rate is a Japanese interest rate. Next slide. In the euro currency market, the interest rate, and there are often the common reference rate for US dollar, for euro dollar would be LIBOR. That would be London Independent Offering Rate. Okay, that will be established in London, but those lending and borrowing are in US dollar. Okay, those are the common floating rate conference in London. In Paris, we have the PBOR, that will be Paris Interbank Offering Rate. In Singapore, we have the SIBOR, we have the Singapore Interbank Offering Rate. Those are the floating interest rate for the lending and saving of a US dollar time deposit and established in those foreign market. Next slide. And euro credits are short to medium term bank loans of a euro currency. So when someone make a time deposit, save money, that's a creation of the euro currency. And the bank, once have this time deposit, surely they want to lend it out. When they lend it out, we call that euro credits. And the loans are denominated in currency other than the home currency of the euro bank. Yeah, right, because we're talking about the lending of the euro currency, and euro currency is a saving that is not denominated in the same currency of the bank. Okay, and this kind of the lending usually is syndicated. That means that a couple of banks team up together, make this kind of lending, usually to a big corporation. Okay, and next slide. And another kind of international money market instrument is the so-called Euro notes. They are short-term note underwritten by a group of international banks, and they are sold at a discount, and then the repayment, the principal would be the principal. So the difference is the interest rate. So the way that the issuance very much like the T-bill. So it's a pure discount note. It's a pure discount note. And typically the maturity is 3 to 6 months. So this is another type of international money market instrument. Next slide. In addition to Euro notes, and Euro commercial paper is another type of the money market instrument. And Euro commercial paper, they are unsecured. Unsecured means that there's no collateral. Short-term notes issued by corporation and the banks. And here we're talking about that it's not going through the underwriting process. Usually is being placed through the private placement to to the investor directly. Underwriting means that they go through the open underwriting security issuing process, and the placement means that you identify someone like Warren Buffett to buy this, big chunks of the commercial paper. And the maturity typically range from 1 to 6 months. Okay. Next slide. And okay, so the next thing would be about the international bond market, and let's stop it here today. Next time when we come back, let's talk about those longer term maturity fixed income vehicle and security. Good.